Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's first question from an anonymous listener. Wife and I are both in our late 30s, 2 children, 5 and 6 years old. Wife doesn't work and have total annual income of around $750,000 including bonus. That's a pretty healthy income. Have around $450 in combined super, so $350 for the husband, $100,000 for the wife. 4 investment properties, 1 in Vic in personal names worth 1.4 with $1 million mortgage. Brisbane residential 1.2 with $750 mortgage in a family trust. Far North Queensland commercial 1.35 with a $900,000 mortgage also in a family trust, and Perth commercial property 1.7, $1 million mortgage also in a family trust. We've got some shares worth $350, cash of $1.4 million in offset account, and $400,000 of extra cash in offset from equity release. So that's not really cash, it's just unused borrowings. We don't have a primary place of residence yet, and we're looking into this. The dream house would cost us $3.5 million, likely knock down and rebuild. I think I've got a few questions. Question 1 is, should we use the cash in the offset to buy property and take the remainder out as a mortgage? Question 2, use the cash in the offset plus sell the Far North Queensland commercial property to reduce mortgage requirements. Number 3, use the cash in offset plus sell Far North Queensland commercial property and sell the Perth commercial property into my self-managed super fund so we can have very small mortgage on our home and keep the Perth property, which has done well so far, and the tenant is very low maintenance. Okay, so my first observation with this to answer this question is, I don't really know what the answer is because we don't have a strategy. And I've spoken before, many times before, that a long-term strategy gives you context for the decision, these sorts of decisions. So the context we need to explore is we've got 1.4 of cash, so we're going to have to borrow $2 million to buy a family home, $2 million in non-tax deductible debt. What's the strategy around that? Does that upset anything? Like, can we repay that $2 million of non-tax deductible debt? Well, they're in their late 30s over the next 20 years, and will that work out fine? Retire by 60, keep the 4 properties, everything works out fine. In which case, if the answer is yes, well, the answer to the question isn't you don't necessarily need to sell any of those 4 properties. It really just comes down to what's the return on investment versus taking on lower non-tax deductible debt. And the compounding impact there is, you would say, after tax, 6%, 6.5% compounding. Now, interest rates might be lower than that, but that's the sort of number I'd do my numbers on or expenses on. So if it's 6% after tax compounding, then you really need to earn a return of, say, 9 or 10% pre-tax to make that worthwhile. So it's a pretty high benchmark. But that's the question, right? And so, you mentioned Far North Queensland commercial properties. So that's the question is, what returns do we expect pre-tax, and therefore also considering after tax, given the ownership structure from that property over the long term, and compare that to your kind of risk-free return, which is, the saving on the mortgage interest after tax. And you compare those 2 numbers and it tells you, what you need to know. However, if we do the numbers and we say, no, taking on $2 million of non-tax deductible home loan today is just too high a debt and it sucks out too much cash flow and there's just too much opportunity cost, then we would definitely look at a way to reduce that debt, and we would sell one of those 4 properties, maybe not 2, but probably one of those 4 properties, the one that we think has the lowest sort of future return prospects. And look, I did an episode late last year about, warning about extrapolating the last 5 years of returns. So in fact, that's episode 381. And, just want to be careful about doing that and making long-term investment decisions based on those outcomes. And also, I think what we need to do when making this analysis is really understand what's going on in these markets, in all markets, all property markets, particularly over the last sort of 5 years. It's a really unique situation where lower value properties tended to perform better. If we're going to make some general rules, of course, there's no just one homogenous property market, that really it's just thousands of different markets and they're all behaving differently. So, as these generalizations aren't necessarily that worthwhile when talking about specific assets, but as a generalization, lower value property's done better than higher value property, and that regional has typically done better than capital cities, and particularly Melbourne and Sydney over the last 5 years. And commercial has had a really significant uplift, like particularly land values for industrial commercial property has experienced huge growth over the last 5 years. And look, part of that is just all us getting used to different borrowing capacity settings and different interest rate settings, I think. And when borrowing capacity gets sort of squeezed, it does skew investment decisions because people are then forced to say, okay, I need greater income. And then more people are forced into that commercial market. What does all that mean, Stuart? Well, you just need to, it's part art, part science with these sorts of decisions. And you just really need to have that experience to sit back and go, well, what's going on? Look, I think in a rising tide, all ships rise. So the Perth property, commercial property will probably still do well. I think, we're getting used to these different interest rate settings and borrowing capacity settings will take a bit of time. So, I can see that probably persisting for a while, which kind of adds to the Perth commercial property in terms of retaining it. Far North Queensland, I don't have any addresses types on that sort of stuff. So it's very difficult to give specific recommendations. And I'm not doing that in this format. This is information only, but just to sort of unpack it a little bit, not only for this listener, but, people in similar situations, maybe you would go, well, it doesn't have a lot of fundamentals. Maybe I can't put my hand on my heart and go, it's going to give me 10% returns, which is, I just don't think you can expect 10% returns over the long run from an asset that isn't in a blue chip location. I just think that's difficult to do. And conversely, it's easy to go, oh, like on Brisbane's probably done really well for this investor. The Victorian residential, assuming it's in Melbourne, probably hasn't done that well just because of the situation. But we're looking at mean reversion probably here as well. So, it's going to put pressure on properties that have done well and maybe put tailwind behind properties that haven't done as well over the last sort of 5 years. But really, it all comes back to what's the opportunity cost? So, what is it going to cost me to take on this higher debt? And what are these assets going to give? And of course, then one's a guaranteed risk-free return in terms of what you can save on a mortgage. And then one has some risk with it. So you need to build in a bit of a buffer there. So just from an economics perspective, you would get rid of the assets that you thought you didn't have a high level of confidence were going to deliver better compounding returns than a reduction in mortgage. But before you even get to that step, it's really, do we have the capacity to take on this debt? $2 million of debt, 750 of income. I reckon your 20-year time horizon, assume you want to retire late 50s by 60, somewhere around that point. I'd imagine the 2 million debt's going to be fine in terms of repaying over that period of time. So I imagine it really just comes down to what is the sort of opportunity cost of selling some of these properties or holding on to them. Anyway, great question, because I guess it does sort of helps people understand, how property decisions can really have longer term financial planning implications as well. And I hope that commentary is at least helpful. Okay, next question is from another anonymous listener. He writes, I've recently hopped onto the Investopoly train at a colleague's recommendation. It's been quite informative, entertaining. Listening to your podcast on the way to work, I've got a reasonably long journey. Well, hopefully it does, make that a little bit more enjoyable. Okay, so give me a couple of dot points in terms of the rundown. Married, 31, wife's 30, live in Melbourne, work in office roles, reasonably stable jobs, both working for about 5.5 years, on 144 and 103 plus super. Purchased a house at the height of COVID boom, a house and land package, and we've now lived in it for almost 2 years. Mortgage is 470 with 210 in the offset account. Purchase price was 560. Properties were probably worth around 700. The property's technically classified as a house, but physically more like a townhouse. Combined super is 165, and they're saving about $5,000 to $6,000 a year, and that takes into account paying an extra $3,000 towards the mortgage. So real surplus cash flow, let's call it $8,000 to $9,000 a month, which is really healthy. Obviously, that tells me they're really good at managing cash flow. Okay, their goals is comfortable retirement, live in an area they like, slightly bigger and nicer house. They don't want to renovate, so would like something that is already renovated. They like sort of inner city to secondary sort of areas like Newport or Caulfield. Want to move to their forever home in 5 years' time. And they're happy in their current home, but that's just the goal, so they don't necessarily need to move. Okay, there's a couple of questions here. I like these questions because the first one was from a high income earner, and this is, one from someone that's just starting out. So it's good to have a bit of variability there. I'm not sure why I shared that observation, but anyway, I just thought I'd mention it. Okay, so a couple of questions. They like the idea of buying into Newport, prefer a fully renovated home, as I said. They've got a budget of 1.3, but because they don't want to be too overburdened with the mortgage, but they're struggling to find something, a house in that price. Should we buy a fixer-upper, a house instead, either in Newport or somewhere else, and rent it out first? Should we buy an investment property instead? Should we just keep saving and then make the move in 5 years' time? Or should we just pay off the mortgage and live mortgage-free and put the rest of our money into super? Are there any other options that we're not considering? So pretty much a catch-all question there, or set of questions, I should say. Look, the first thing is, this is not advice, it's information. I mean, I always say that. But the first thing is that, you've got to, it's a balancing act, I guess, because as a financial advisor, I can sit here and say, well, would produce the best financial outcome. And then my clients have to add their own personal lifestyle considerations, because I can't necessarily say to someone, look, this goal is more important than that. Like the financial goal trumps every other goal that you have, or every other sort of lifestyle goal that you have. Of course, that's a nonsense. There's going to be some goals that, and I can't make that decision, right? Probably, a really good example of that decision is whether they have a third child, for example. People have already two children. Should we have a third, or should we? I mean, that's that's not really a financial planning decision, right? That's a lifestyle one. I can tell you what's the implications, but of having that third child, so that you can kind of weigh it up. At the end of the day, that's your choice. And so that's the first thing. But I think it's just like I believe most people will make really sensible decisions that are ultimately going to balance these things out. It's really that just having the access to all the information to do that. And also to kind of foresee how things play out. Look, I've said it a number of times that the home, your home can be one of your best investments, and that there is a lot of non-financial benefits of living in an area that you really enjoy living in. And that's not to say everyone should move to like a blue chip suburb. That could be anywhere in Australia, but it's got to really connect. So, I think, and there's a long runway here. These people, the listeners are early 30s. So, another 3 decades potentially of experiencing the decision that they make, their next financial decision. I also think that there's only a handful of decisions in our life that we need to nail. So if they nail this decision and really get it right from a financial perspective, it will change their financial position dramatically. Whereas if they completely mess it up and make the wrong financial decisions, putting aside their lifestyle considerations, it could really retard their ability to be in a strong financial position. And this is kind of one of these sorts of decisions. They've got into the market. Okay, they might look and say, well, it's the wrong time, peak of the market, peak of COVID, but they're in there now and they've built equity in this property, and that's great, and they're happy to live there. But now it's just about compounding that already good decision. So that's the other thing I would say. Look, you are far better off. From my perspective, it's all about land value. And, how much does that land, if you want to go and buy a parcel of land in Newport, for example, I'm going to pick on Newport just because you mentioned it a couple of times, but it's a good example. So if you want to go and buy a block for, 400 square meters, let's say, that size, something that you can have a house and a bit of backyard, not a huge backyard, but some backyard, or maybe it's larger than that, I don't know, but I'm just going to use that as an example. 400 square meters. How much does that 400 square meters cost you today versus how much will it cost in 5 years' time? And, I've spoken about Melbourne, mean reversion, the fundamentals, all those sorts of things previously in this podcast. I'm not going to go over all that data again, but I think you look back and go, well, the probability is it's going to cost you materially more in 5 years' time. So go buy that land today and then put a tenant in that property. Now, the best thing you can do, because construction costs will change, and I hear you because I want to acknowledge that I'm not ignoring the desire to not have to go through a renovation, but the construction costs will change, but it'll probably level out. In fact, we can see it in the data, the CPI data, that construction costs are actually quite flat over the last 2 years. And that's not a surprise, right? Because we had some ridiculous increases in construction costs throughout COVID, and it'll probably a bit of mean reversion will level out now. So, it will cost you more to construct a home or renovate a home in 5 years' time, but not that much more. Like we're probably talking CPI or less. So really the best financial decision you can do is go and buy your parcel of land. Hopefully there's a dwelling on it. That dwelling just has to be tenantable. It doesn't have to be in good condition, just good enough condition to put a tenant in it. And the best thing that you could do then is put a tenant in it and move in when you're ready to move in. So when the mortgage starts to feel comfortable. Because you said, I don't want to overborrow. I hear you, but you've got a strong surplus cash flow. So you can afford to make that move now. Maybe you can't afford to make that move as a home loan, as a non-tax deductible home loan. But, it's funny how things can change over just the course of a couple of years. A few salary increases, maybe change in interest rates, a little bit more equity in the home makes you feel a bit more comfortable. And 3 or 4, 5 years down the track, it might feel comfortable moving to that asset. Meanwhile, you can still put money in your offset account to, accumulate that cash. So if I was in your position, that's what I'd do. I think that's probably the best long-term financial decision. I think in 10, 20, 15, 20 years time, you'll look back and go, yep, that was a good decision and probably the best decision that I could make at the time. I've said it before too, like, you don't want to compromise here. So I would be spending most of my money on the land rather than the actual improvements on that land, so the building value. So it's just a question of whether 1.3 is going to be enough for that. Maybe if you're making some more compromises on the building, maybe it is. But you really want a nice quiet street, good location within Newport. You want as much land as possible within that good location. So make as fewer compromises as possible. And if you feel like now's the right time and you can make that acquisition without making too many compromises, then now's probably the best time to do that. You've got plenty of time to, repay mortgage, contribute to super, invest in the share market, do all those sorts of things. I think the way I would look at this is that you've bought a house and land package, it's done well. That the market movement has been in your favor over the last 5 years. It's not always going to be in that circumstance. So it's really just about saying, okay, good, how are we going to make this equity work really well for us? And then go and buy that land. And then in the future, you can go and sell your existing property to reduce debt and fund a renovation. And hopefully then in 5 years' time, you're in a really good position in terms of having a lot of equity in this house. And essentially what you've done is reinvested the equity that you have in your current home just in a better location that's going to provide some compounding benefits. And, if you really connect with that location in terms of you think it has superior amenity, then there's going to be some good lifestyle implications as well. So thank you for your question. I hope that helps. And I've answered similar questions like this previously in terms of I've always been in favor of upgrading the home. That's not to say that would be my answer in every single situation. But I think when someone is young, early 30s, they've got a strong cash flow position, then, to me, it looks like a natural best step. Okay, next question is from Patrick. Patrick writes, I've recently found your podcast and really enjoyed the comprehensive knowledge that you've shared throughout the episodes I've listened to, particularly recent episode on return on borrowing capacity, which has led me to ask this question. Yeah, I like that episode, return on borrowing capacity. That's the scarce resource. That's the one that you should be allocating as effectively as possible. Okay, Patrick writes, I'm 24 and bought my first apartment in November last year. Congratulations, Patrick. That's an awesome start. Since then, I've had a 50% pay increase along with rate cuts on my monthly cash flow, which is substantially improved. Well, unfortunately, Patrick's writing this in early November. Unfortunately, I'm answering this in mid-February almost, and unfortunately, we've had a rate hike. So anyway, but Patrick's still off to a flying start. My plan has been to save money in my offset for debt recycling in the future, especially with expensive markets at the moment. I think he's talking about the stock market, along with some small renovations to the apartment, changing laminate flooring to wood/hybrid and putting in a kitchen island. My question is more generally about optimizing my financial position in regards to investing and utilizing my now increased borrowing capacity, and whether my current plan would align with what you think if you're in my position. Additional information, if it's relevant: income is 150 base plus 10% bonus, 40,000 in super, 30,000 in ETF, 60,000 in cash, 21,000 is for the emergency fund. Apartment bought for 615 with a mortgage of 410. Thanks in advance for your question. Please let me know if you'd like any information, extra information. Okay, Patrick, look, at yours is another really good question. I feel like we started 40s, gone to 30s, and now we're in our 20s in terms of questions from people, which is great. It brings up something that's an observation I like to just talk about that I've observed over the past couple of decades, which is it can be a bit of a frustrating point, but it's something to acknowledge and I think to sort of talk about and to help people navigate. And the issue is change in circumstances, right? So Patrick's just experienced a 50% pay increase, which has changed his borrowing capacity, his financial situation. Whereas as I'm reading it, when he bought the apartment, he was in a different financial position. So, and it happens quite regularly. It happens a lot when you're younger because quite often and, things are changing pretty quickly, particularly as you build out your own career. But the thing is, we must not let past decisions, it's a sunk cost, a past decision. So we've got to sort of start fresh. And I wouldn't let any of my past decisions really influence what I'm thinking about today. So, for example, if I bought a property and I had to make some significant compromises, and then all of a sudden, a few months later, my situation changed, permanently changed, and I had high level of confidence that it had in fact permanently changed, then I've got to throw that decision out and start again. And that's really the best decision you can make. Whereas sometimes we hang on to investments or financial decisions that might have been fundamentally sound at the time given the set of circumstances. When our circumstances change, if we can make improved financial decisions, we should do that. Now, I'm not saying, Patrick, I'm kind of hinting at it, but I'm not saying it because I don't know. I'm not saying Patrick should go and sell this apartment now and take advantage of his far improved cash flow and borrowing capacity. But what I'm saying is Patrick shouldn't be too worried about doing that. And in the short term, you might go, okay, you got selling costs, you got stamp duty again to get back into the market, all these sorts of things. Yes, yes, yes. But also what we're trying to do is make what is the best thing that Patrick could do today? So when he looks back when he's 34 in 10 years time, he goes, thank God I did that back in 26 because, if I hadn't have done it then, it would have put me in a different situation. And Patrick's very young. So his goal here is to leverage his income as much as humanly possible. And I don't mean do whatever you can and be stupid without considering, servicing that higher debt and whether you're comfortable with that higher debt and thinking about things like, what if I lose my job or change jobs or whatever. I'm not talking about that, but clearly from what Patrick's told me, he's good at managing cash flow. He's got 60 grand in cash, 30 grand in ETFs and a property with relatively low debt, $410,000. So I would look at that situation and go, you're under leveraged. And the answer is probably yes, he is, because his circumstances have changed. So Patrick, what I would do is I would look to see if you can use this property, even though you only owned it for a short period of time, as a stepping ladder, I should say, to a better property. And I would be open to, I don't know what the apartment is like in terms from a quality investment grade perspective, but if it wasn't, if you didn't have high confidence with it, then it means sell it and upgrade. And I know it sounds like a really aggressive move that's going to give rise to cost and so forth, but it really does come back to this observation that I shared right at the beginning, which is a past decision is a sunk cost. And what you got to do is ask yourself, would you have made this decision if you knew that you were going to get this 50% pay increase? And by the way, I'm premising this on that you believe this level of income is sustainable. So if it's not sustainable or you're not 100% sure it's sustainable, then don't make the decision, of course. But I'm just saying the premise of my answer is that it is sustainable. Anyway, if I go back to, would have you made the same decision, going back last year in November? The answer is probably no, because you would have had a greater budget. Or if it is, then you realize, well, at least now you need to sort of start afresh and not let that past decision weigh on what might be the best 10-year decision that you can make today. So I don't think it's about investing in ETFs. I don't think it's about putting money into super. I think it's about getting the most amount of leverage so that you can enjoy the most amount of compounding capital growth over the next decade and beyond. But thanks heaps for your question, Patrick, and good luck with it all. Okay, another question from anonymous listener going back to an older couple now in their early 50s. They've immigrated to Australia. They want financial independence by 65 with $180,000, to spend $180,000 a year. Currently living in regional Victoria, plan to move to Melbourne in 3 years' time when daughters finish high school. They own their own home worth $1.5 million with $650 mortgage. Mostly offset. Okay, so not too much of a home loan. 2 investment properties in Queensland. Combined household income about $400,000. Husband's a physician and wife is tax lawyer. And they follow a passive, diversified strategy across property and shares through a self-managed super fund and ETFs. That's good. Self-managed super fund holds a Queensland property worth just under $1 million with $610,000 in debt, $37,000 in rent, and $80,000 in ETFs in the self-managed super fund. Given their plan to move back to Melbourne in 3 years' time, should they sell their current home and buy in Melbourne? They've got a budget of 2 to 2.5, or buy a property in Melbourne now and rent it out and move in once we relocate. How should we think about timing, tax efficiency, and opportunity cost between these two options? It's a great question. I mean, they're all good questions. It's hard. When you're planning around tax efficiency and strategy, that's good. But what's really unknown is market timing and how markets will change. So, you might come up with the best tax strategy ever, but if the market moves against you, that's a challenge. I find that the best analogy is, for example, selling shares, and particularly as I record this, we've been selling quite a bit of BHP for clients. Not that we buy direct shares, but they come to us if they have direct shares, that clients already have them. So anyway, we think that it's been a really good point of BHP, and last year it was CBA. And it's funny because you'll look at it and go, I'm going to pay a lot of CGT. That's true, and it's going to give rise to a lot of CGT. But the flip side is the share price drops, and what you save on CGT, you lose a lot more on a change in market value. So I guess what I'm saying is, it's hard to map out the best plan from a tax efficiency perspective if you then also need to consider market movements and practical considerations. So I'm not saying ignore it, but it's a challenge. The next thing, if you live in regional Victoria, my first question is, are you going to be able to find a house to rent? So if we wanted to sell today and then go and buy in Melbourne, which I'd be leaning towards for all the reasons I've spoken about previously, I'd be leaning towards making that move now, particularly as regional has tended to done better. So what you're doing is switching out a market that's done better than a capital city market, so Melbourne, and so sort of moving that equity into what I would argue is to an asset that has better intrinsic value. Yeah, so can you find a home to rent? Because that can be a challenge in some regions. I don't know where they live, so I can't make that assessment myself. Let's say it was worthwhile. Then the next thing we've got to think about is we're not fully utilising the main residence CGT exemption. So if they sell and go and buy an investment property and then put a tenant in that property, that's not ideal because they can't claim it as a main residence. So my next question would be, is there any opportunity to occupy that property for a few months, or at least a few months, just enough time to genuinely occupy it as your principal place of residence, and then keep enough evidence to show that? So change of electoral roll, change of address details on licenses and memberships and all those sorts of things. Keep electricity bills and water bills to show that you were actually using the services, and it demonstrates that you were actually living there full time. If you're able to do that, and there's no set period of time in the legislation, but I would say 3 to 6 months, longer is better, but 3 to 6 months, somewhere in that range should be enough. Then you could potentially go and buy that property, occupy it for a short period of time, and at least then claim it as your main residence, then put a tenant in it, and then go and rent back in that regional town. That would be ideal, because what you're doing, as I said, is you're moving that equity from a market that has done better than a capital city market over the last 5 years. You're buying when I think prices have bottomed out. We've seen small increases in median house prices in Melbourne over the last year. So I think there's, the data's telling us that it's certainly bottomed out. So you're sort of probably buying at the bottom end of the cycle, and then you're getting the main residence exemption, and then you'll get some negative gearing benefits over the next couple of years as well. And you're on high income, so you're going to enjoy the maximum negative gearing benefit there as well. So without knowing, where you own the property, what type it is, how easy is it to sell, all those sorts of considerations, that's what I'd be looking to do. Now, if the answer was no, we couldn't easily occupy because it's going to be challenging, particularly if your kids in school and so forth, I would probably still be inclined to do it, as in make that move. Because let's not forget, what we've got to measure is, if you're buying for 2 to 2.5 today, you've got to think about over the next 3 years, how much will your $1.5 million property change in value in dollar terms versus how much will that $2.5 million property change in dollar terms. So even if the percentage change is the same, the dollar value difference is going to be a lot different. And so then you've got to consider, like, economically, what's the opportunity cost of selling versus not selling. And because you're spending a lot more money coming into Melbourne, and because regional's done better than capital city over the last 5 years, and because there's no guarantees, but we think we're pretty close to the bottom of the market, I think I'd still make that move now, even though you might crystallize a unrealized CGT liability for the next 3 years if you can't make it your main residence when you first purchase it. Okay, I hope that answers your question, and thanks to everyone for their questions. Of course, you can get us at questions@investopoly.com.au, and we very much look forward to answering your questions. Campbell and I are actually going to do a live Q&A on YouTube, probably in the evening, because I think that's when most people have a little bit of spare time to listen to these things. Anyway, we'll tell you about that. We're just planning it, and if it's successful, we'll do a few of those sessions, I think, and you can kind of see, how Campbell and I might argue over the answer, or workshop some ideas, or throw some ideas around. Okay, we'll leave it there. Tomorrow, I'm going to point out how old I am, and by talking about the dot-com bubble, and that which happened in early 2000s. And what I'd like to do is relate that to the AI trade today. So what can we learn from what happened, 25 odd years ago, in terms of which was driven by, an expected technology change, and how can we relate that to today? So taking an evidence-based approach, of course. Okay, that's it from me. Until then, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it'll take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.